Hello and welcome to this quarterly update from Luna Investment Management. My name's Alex Brandeth, Chief Investment Officer at Luna Investment Management. And today we're going to be going through what happened in the quarter from an inflation perspective, the changes that this has meant from an interest rate perspective, and how that's impacted markets. I'm going to start sharing the screen now and we can go through these slides. As I mentioned, the ongoing high and sticky levels of inflation has been a key topic over the quarter, and we'll touch on why that's been the case and why inflation is being more sticky than expected. Economic growth has been actually quite stronger than expected. When coming into this year, it was widely expected that the UK, US, and Europe would be in a recession, and that's certainly not been the case. And as always, what we could spend a lot of time considering is, well, how does this impact investment markets, whether it be bonds or equities? And we'll touch on that today, as well as giving some views on the outlook looking forward. So what's been happening with inflation? This chart looks at the different components of inflation going back to 2021. The orange line is the aggregate level of inflation, and the bars represent the different elements that have been contributing to inflation over the last 2 years. So the big change last year was this grey and these kind of lime green bars here. They went, as you can see, they increased significantly. That's electricity and gas, and it's liquid fuel, so it's petrol that goes into your car or diesel. They increased significantly, as we know, following the war in Ukraine and Russia's invasion. But you can see here that over recent months, they've started to have less of an impact, and they've started to be smaller contributors to inflation. In fact, liquid fuels is actually now deflationary because it's falling in price. But on the flip side, you've seen these 3 bars here having an increasing impact in inflation. So what are they? The blue bar is core services. The green bar is core goods, and then the purple bar is food, alcohol, and tobacco, which have been increasing in value. Now, let's start off with some good news on inflation. Inflation has fallen. You can see it peaked in September last year, the end of last year, at kind of 11%. This is headline inflation. That has fallen to 8.5%. So that's the good news. The bad news is it isn't falling as quickly as everyone would have hoped, particularly the Bank of England. Now, what about looking forward? Well, you've already seen electricity and gas fall significantly, and as we come to the next energy price cap, that's expected to fall again. Supermarkets are now saying they're starting to see food prices stabilise, so the impact of food is likely to be less. But on the flip side, we are seeing wage inflation coming through hotter than expected. We just had a reading recently which showed that wage inflation in the UK is running at 6.9%. And that's how companies can pass on higher services and core goods prices through as well. So that's why you're seeing more inflation there. So it's possible that this inflation could stay sticky for longer than expected, maybe at the outset of the year. So as we touched on, the reaction from the Bank of England has been to increase interest rates. Increase in interest rates, it means that cost of financing becomes less attractive and there's less demand going out there. So that's why they've been increasing interest rates. Remember, the Bank of England has a target of 2% inflation. We're very much far away from that at the moment. The expectation is that interest rates will continue to increase in the short term, and the market's pricing that interest rates get to about 6% in the coming months. So there's expected to be further interest rate hikes coming through. That being said, as you can see from the chart, we've gone a very long way very quickly. Interest rates back in 2021 were down at 0.1%. They're today at 5%. It's been one of the fastest hiking rate rises that we've seen in our lifetime. So a lot of work has been done, and we are getting to the end of this interest rate cycle, which is important because that's had a key impact on the number of asset classes. But we are still yet to feel the impact of interest rates being passed on. Now, on the left-hand side here, this looks at the makeup of the UK mortgage market, and it goes back to 2016. If you look at 2016, roughly 45% of the mortgages in the UK were floating rate. Now, if we were seeing those interest rate rises come through and we had a floating rate mortgage, we'd be feeling the impact straight away. But what's happened, because we've been in a world of low interest rates for a long period of time, is that more and more individuals have fixed their mortgages. And you can see that today it's only around 14% of the mortgage market is floating rate. And on the flip side, you can see these purple bars have been increasing significantly over the last few years as well. And they're fixed for 5 years. So because rates have been so low, people have been fixing for more certainty for longer. However, over the next, 5 years or so, as those mortgages are rolling off, then it's going to have an impact and we're going to be exposed to higher and higher rates. So let's just put some numbers out there. Maybe the average fixed rate mortgage was 2% a year or so ago, or 2 years ago. They're more likely to be closer to 6% now, which is a significant increase in the cost of the financing of that debt. And this chart just shows on the right-hand side, kind of the cumulative percentage of outstanding mortgage debt, which is going to roll off in the coming years. So this year, there's just under 40%. Next year, it's just under 60, then 70, 80, and 100% of mortgage will be refinanced until 2027. So if interest rates continue to rise and then stay higher for longer than expected, then this is going to have a big impact on the UK economy. That being said, if on the left-hand side here, when we showed this earlier on in the year, it was expected that the UK would be in recession. Most economists are now expecting the UK won't go into recession this year and is going to see very slight, modest growth. And that's exactly what we're seeing from the readings that have come through officially from GDP already this year. You've seen basically flatlining of 0.1% per quarter. The same is very similar for Europe. And you can see that the US, which is on average grows at 3% in a good time, is expected to not grow as quickly this year. On the right-hand side of this page, you can see purchasing manager indices. We look at these very closely because they give you a really good indication of what's going on with the economy right now. And as you can see, the optimism this year was driven by the fact that these lines were above 50 here, but more recently they've dropped back to 50, which means that the economy is not growing to the same extent. So there is signs from an economic data perspective that things are slowing slightly. So how has this impacted investment markets? And I think as investors, we tend to spend a lot of time talking about equity markets and maybe not enough time talking about bond markets. And it's certainly been the bond market that's been impacted most significantly over the last 3 years. So this chart looks, as I say, over 3 years, and it compares gilts in blue and corporate bonds in red. And you can see that a safe haven government bonds, almost when the interest rates started to increase, this is the beginning of 2022, have fallen by almost a third. That's a significant fall in an asset which is meant to be, as we say, a safe haven, falling by 33%. Corporate bonds don't tend to be as long in their duration, and therefore they've still fallen in value, but they haven't fallen in value to the same extent. So they're down only 22% over the last few years. Now, just as a reminder, Luna's been structurally underweight bonds for a long period of time because we felt that they were expensive. So this positioning has helped us protect portfolios better than some of our peers. But what about today? So as we look at bond markets today, this is what is on offer. So the bars represent the current yield. So if we look at the UK 10-year government bond, which is this blue bar here, the current yield is around 4.5%. The diamond represents where it started at the beginning of 2022. You can see from all of these charts, whether it be corporate bonds here, high yield bonds, or emerging market bonds, that the bars are all higher than the diamonds. There's been a whole repricing of the government bond market, the corporate bond market, and other bond markets over the last 18 months. That's been driven by interest rates being higher and higher inflation. That's, as we've seen from the prices of bonds, that's a huge negative. But as bond prices fall, the yields go higher. And that means from today, there's a lot more attractive bonds on offer within portfolios. And as well as that, you don't have to take a lot of risk. You can get short-dated bonds, which are offering very high returns at the moment because they've been repriced because of this interest rate environment. So yes, it's been an extremely negative market for bond investors, but looking forward, the opportunity set seems a lot higher. What about equity markets? So we've got a number of equity markets on the chart here. You've got the S&P 500 in that dark blue line. You've got the Nikkei 225 in that maroon line. FTSE 100 in yellow. You've got the green line here, which is Europe, and then you've got the Hang Seng, the Hong Kong stock market in blue. So let's just pick this apart. So this is a 3-year chart. As you can see, in 2021, the US market was the best performing market. And then last year, it really stalled. And that's because a lot of the tech-orientated companies had been overvalued after going into COVID, and a lot of the share price performance had come through. On the flip side, the UK had a much better year last year and was very strong. You can see that coming through here. And at one point, it was the best performing stock market over this 3-year period. And that's a function of the fact that it has more exposure to commodities, oil, and banks, which have performed slightly better than technology-orientated businesses more recently. UK and Europe performed pretty much in line, but you can see the fear of Russia and Ukraine here impacted the European equity markets more. And Japan's been on a real surge more recently and has been one of the best performing stock markets this year. On the flip side, Hong Kong and by default, China has been having a much tougher time. China was in lockdown for a very long period of time. They announced that they were coming out of lockdown last year, and you saw an initial rally from that. But since then, that euphoria has waned, and the share prices have been significantly weaker. As we said, the S&P 500 has been the best performing stock market over this time period. And it's performed very well over the last quarter. You can almost see the jaws opening up with the UK. The US has gone on to perform very strongly, but the UK has come under pressure. And some of the performance, or a lot of the performance within the US has been coming from the top 10 stocks. So if we just highlight some of them and some of the share price movements that we've seen just this year. Nvidia, the chip maker, is up 200%. Why is it up 200%? Because it's very much linked to artificial intelligence, which has been a key story with investment markets this year. Apple is up 50% this year. Meta, also known as Facebook, 135% this year. Tesla, up 150% this year. So you're seeing some very big moves from the share prices of these large US businesses. And what's happened is this. So going back to 1996, it looks at the top US companies and it looks at the valuation of them. If you're up at the top of this graph here, you're expensive. If you're down here, you're lowly valued. And you can see the significant increase in the value of the top 10 US stocks. They aren't earning anything more. It's just being driven by share prices going up, and therefore these companies becoming more and more expensive. To us, that is a slight concern, and we've been looking to reduce our exposure to US growth companies that have significant positions in this. As I kind of said, these companies are not earning any more revenue. They've simply just gone up in price, which makes them more expensive. And we have seen periods like this in the past. So this is the tech bubble here. This is COVID. And these tend to be very elevated levels for these types of businesses. So we're looking to take profits. On the flip side, you can see the rest of the stock market really hasn't gone very far at all in the US. It's the top 10 companies have been driving positive performance. The 490 companies have been actually delivering negative returns this year, which is quite astonishing. So in summary, inflation in the UK remains stubbornly high. It has started falling. It's likely continues to do so, but it's been a lot stickier than most people had expected. This has caused a headache for the Bank of England, and they've increased interest rates to a 15-year high. But in the US, you've seen a pause, and you're starting to see that we are getting closer to the end of this interest rate cycle, which is incredibly important for bond investors. It's going to also have an impact on the UK property market, and you've already started to see that with property values coming through, but there's more to come over the coming years. We do think bonds are starting to look attractive. There have been significant falls in this asset class over the last 18 months, and the yield on offer now is significantly more attractive than they have done in the past. The US market has been driven by a handful of companies linked to artificial intelligence. Whilst it's been positive that you're seeing such a demand come through, it's still very early days with regard to the key winners from artificial intelligence is going to be. So we think that there's too much valuation being baked in the short term, and it's concerned us, and we've reduced our US equity exposure. That's all from me. I'd just like to thank you for listening today. If you do have any questions on this or anything further on your portfolio, please don't hesitate to be in contact with a member of the Luna team. We'd only be more than happy to help. Thank you very much. Goodbye.